$20 billion, gone in 2 days. It was not a theft, it was not a mistake. It was a mathematical inevitability buried in the contract. Bill Hwang did not use a gun. He used a loophole, a silent mechanism that allowed him to own the market without ever putting his name on it. Most funds file Form 13F. They tell the government what they hold. Hwang did not. He ran a family office, private money, zero reporting requirements. This exemption made him invisible. But invisibility was not enough. He needed leverage. He needed to buy companies he could not afford. Enter the total return swap. A swap is a contract. You do not buy the stock. The bank buys the stock. The bank holds the stock. The bank is the legal owner. You pay the bank a fee. The bank pays you the profit if the stock goes up. If the stock goes down, you owe the bank the difference. This is the trick. On the shareholder registry, the name is Morgan Stanley. The name is Goldman Sachs. The name Bill Hwang appears nowhere. He is a ghost. The banks loved it. They collected fees. They held the collateral. They thought they were safe. They did not know Hwang was doing the exact same trade everywhere. He went to Credit Suisse. He bought Viacom. He went to Nomura. He bought Viacom. He went to Goldman. He bought Viacom. Every bank thought they were the only one. The exposure compounded. Hwang did not own a piece of the company. He effectively owned more of the company than the company itself. The leverage was critical. 5 times leverage. For every dollar he had, he borrowed 5. If the stock drops 20%, his equity is 0. He is wiped out instantly. The bank saw a whale, a perfect client paying millions in fees. They competed for his business. They loosened their rules. They invited the predator inside. Risk departments raised flags. They asked about his other positions. Hwang refused to answer. He threatened to leave. The banks backed down. Greed silenced the warnings. This is the mechanism of the collapse. Concentration, leverage, invisibility. It works until the music stops. And on March 22nd, the music stopped. ViacomCBS needed cash. They announced a secondary offering. They wanted to sell $3 billion in new stock. The market reacted poorly. The price slipped. A small drop, 4%. For a normal investor, it is a bad day. For Hwang, with 5 times leverage, it was a structural fracture. The phone rang. Goldman Sachs, margin call. They needed more collateral. Hwang checked his accounts. He had no cash left. He was all in. He asked for time. He told them he would fix it. But he had the same conversation with Morgan Stanley, Nomura, and Credit Suisse. The trap snapped shut. The banks realized the truth. They were not holding diverse assets. They were all holding the exact same bomb, and the fuse was already burning. To understand the crash, you must understand the anomaly. Bill Hwang was not a new graduate. He was a veteran, a tiger cub, a protege of Julian Robertson. But he had a record. In 2012, his previous fund, Tiger Asia, was charged with insider trading. He used confidential information to short Chinese bank stocks. The penalty was severe. He pled guilty to wire fraud. He paid $44 million in fines. The SEC banned him from managing outside capital. He was blacklisted. Goldman Sachs put him on a do not trade list. Morgan Stanley refused his business. He was a pariah. Wall Street closed its doors, or so it seemed. Hwang did not quit. He pivoted. He took $200 million of his own money and opened Archegos. Because it was family money, the regulations did not apply. He crafted a new image. the humble monk. He sat in a simple cubicle. He carried a backpack. He held Bible study sessions in the office every Friday morning. To understand how he returned to power, look at the year. 2020. The Federal Reserve printed $3 trillion to fight the pandemic. Cash flooded the system. Interest rates hit zero. Banks could not make money on loans. They were starving for yield. They needed clients who borrowed heavily. They needed Bill Hwang. The prime brokerage division is the engine of Wall Street. They lend shares. They lend cash. They charge interest. It is low risk, high volume, usually. Hwang was paying tens of millions in financing fees. He was a whale client. In a zero-interest world, a whale is protected. Compliance rules are flexible for whales. Profit erases memory. Goldman Sachs removed him from the blacklist. Morgan Stanley invited him back. Credit Suisse gave him a dedicated desk. The competition for his fees began. Hwang used this trust to concentrate his bets. He did not buy the S&P 500. He bought a handful of stocks: Viacom, Discovery, Tencent Music, Baidu. He bought so much, he became the market. When Archegos bought, the price rose. When the price rose, his collateral increased. When collateral increased, he bought more. Hwang used a mechanic called a gamma squeeze. He didn't just buy stock, he bought options. This forced the banks to buy even more stock to hedge their risk. Every time Hwang bought, the banks had to buy. The buying pushed the price up. The higher price forced the banks to buy again, an automated feedback loop. It wasn't investing, it was engineering. He was hydraulically pumping the market cap of Viacom. He turned a media company into a meme stock. Short sellers tried to bet against him. They were crushed. The relentless buying power of 6 global banks wiped them out. Hwang was invincible. By March 2021, Archegos held positions worth $100 billion, but net capital was only $20 billion. The leverage was stretched to the breaking point. The banks checked their risk models. The models said low risk because the stocks were liquid and rising. The models did not know about the other banks. It was a house of cards built inside a wind tunnel. Hwang sat in the center, calm, reading his Bible, while the pressure gauges silently redlined. Then came the catalyst. Viacom decided to sell stock. They wanted to raise capital while the price was high. They didn't know the price was artificial. The market choked. Who would buy $3 billion in stock at an all-time high? Nobody. The price stalled. Then it ticked down. The loop reversed. Gravity returned. The leverage that built the fortune turned around to destroy it. And this time, there was no way to hide. Thursday, March 25th. The market closed. Viacom was down 9%. Discovery was down. The collateral in Hwang's account had dropped below the minimum requirement. The prime brokers ran the numbers. Hwang owed Morgan Stanley. He owed Goldman. He owed them all. The total margin call exceeded $10 billion immediately.
Hwang had no liquidity. His cash was deployed. He asked the banks for forbearance. He asked them to wait. He claimed the market would bounce back.
Thursday night, a secret emergency meeting. The 6 major banks dialed into a conference call. Credit Suisse, Nomura, Goldman, Morgan Stanley, UBS, Deutsche Bank. Credit Suisse proposed a standstill. No one sells. They coordinate a slow exit over weeks. It was the only way to save the market from collapse. Silence on the line. No one signed a contract. No one gave a guarantee. The call ended without an agreement. The truce was a handshake with ghosts. Friday morning, pre-market. Goldman Sachs had a rule. First out, best out. They looked at the volume. They knew the market couldn't absorb 20 billion. They didn't sell on the open market. They called hedge funds directly. We have a block of Viacom, 5% discount, take it or leave it. Goldman dumped $5 billion of stock in block trades. They cleared their books before the bell rang. They chose survival over the collective good. Morgan Stanley saw the prints. They saw the block trades crossing the tape. They realized Goldman had broken the truce. They panicked. The race was on. It was no longer about saving the client. It was cannibalism. The banks were eating each other. They dumped 5 billion, 8 billion. The floodgates opened. The market opened. Viacom crashed. Discovery crashed. Tencent crashed. The sheer volume of selling overwhelmed the buyers. The stock prices fell 30, 40, 50%. Credit Suisse and Nomura were slow. They respected the standstill. By the time they tried to sell, the price was gone. The buyers had vanished. This delay cost Credit Suisse $5 billion. Every minute they waited, the price dropped another percent. Loyalty in finance is an expensive luxury. Goldman Sachs lost nothing. Morgan Stanley lost nearly nothing. They exited first, the first mover advantage. In a fire sale, the only prize is survival. Nomura lost $2 billion. Credit Suisse lost $5.5 billion. They were left holding the toxic assets that no one else wanted. By Friday evening, $20 billion of wealth had evaporated. It wasn't transferred. It didn't go to someone else. It simply ceased to exist. Bill Hwang's fortune was gone. His reputation was destroyed. But the damage to the system was just beginning. The regulators woke up. The collapse of Archegos was not just a loss of money. It was a structural failure that broke a 160-year-old institution. Credit Suisse was mortally wounded. The bank had ignored too many warnings. Archegos Capital, Archegos. The $5.5 billion loss was the final straw. Clients fled, the stock plummeted, the bank died. UBS bought the remains for pennies on the dollar. A giant of European finance was erased because they trusted a ghost with a history of fraud. The cost was absolute. The damage extended beyond the banks. The Grace and Mercy Foundation, Hwang's charitable arm, held $500 million in assets. It was all invested in Archegos. It vanished. April 2022. The FBI agents arrived at 6 in the morning. They arrested Bill Hwang at his home. The charges were heavy: racketeering conspiracy, securities fraud, wire fraud. Prosecutors used the RICO Act, a law designed to take down the mafia. They argued Archegos was not a fund, but a criminal enterprise designed to manipulate prices. The trial lasted 2 months. The defense argued he was an optimist who believed in the companies. The prosecution showed the texts. They showed the lies to the banks. November 2024. The judge read the sentence: 18 years in federal prison. Hwang stood silent. He is 60 years old. He will likely die behind bars. Comparisons were made. Sam Bankman-Fried got 25 years. Hwang got 18. The message from the court was clear. Manipulating the public markets is a capital offense. But Hwang is just one man. The mechanism remains. The total return swap is still legal. The family office exemption is still active. The data is still hidden. The banks paid fines. They updated their compliance manuals. They hired new risk officers. But the incentive structure has not changed. Fees drive the system. Greed drives the fees. Somewhere in a quiet office, right now, another fund is leveraging up. Another ghost is building a position. Another bank is looking the other way. The cycle repeats. Archegos was a $20 billion lesson. The market memorized the number, but it forgot the method. The blind spot is not a bug, it is a feature.